clearly define the payment terms. You also need to keep up-to-date records when you do supply customers on credit, up-to-date records of who's paid you and who hasn't paid you. And you need to be rigorous in chasing people who do not pay you. So those three rules apply if you're selling goods or services on credit. It involves time and a time commitment, but it will pay dividends in the long run. The other thing about managing your finance is you must always know how much money you've got in the bank. And I like to say you need to think up to 3 months ahead. And you need to have a good idea of what your bank account will do over balance will do over the next 3 months. And my reason for saying that is quite simple. Small businesses are notorious for going to the bank and saying to the bank, I want to borrow some money and can I have it in less than a week? Now, banks don't operate in this less than a week time frame. A bank will usually take between 2 and 4 weeks to agree to lend money. So you need to have that short-term 3 months view so that you can see am I going to need to go to the bank or whichever finance provision you're thinking of. So try and keep in your mind's eye, what is my bank balance now? How is it going to look over the 3 months? Right. The next thing is, if you do decide you do need to raise finance, there are some key questions that whatever type of finance you try to raise, you will need to answer. And the first question is, how much? How much money do you want? Now, I've seen businesses go to a bank and say, I want to raise £50,000, and then they produce some projections which suggest they need £100,000. So they need to have a clear focus on how much they need to raise. They need to think, how long do I want it for? They need to think about how am I going to repay it? If it's a loan, how am I going to repay it? And if it's an overdraft, when am I going to be able to repay it? The bank will want to know, why do you want this money? Is it for growth because your business is expanding and all those sorts of things, which is usually taken as a plus? Or is this simply to maintain the business at its current level, which is usually a negative? You'll also be asked if it's a loan or an overdraft, are you prepared to offer some security? Now that may be a personal guarantee, it may be an asset or overall the assets of the business, or it could be a personal asset. So for example, if you're applying for an overdraft, they will often ask for a personal guarantee. On the other hand, if you're applying for hire purchase because you want to buy a vehicle or some equipment, usually that's enough of a security for the HP company. So that's all you need to do, is give them the security of the asset. And unless the asset is extremely unusual, that's very common sort of way of dealing with this. The other thing is, for some businesses, and we've already had a discussion around that earlier, they want to issue some shares and sell some interest in the business. Lots of small business owners are dead set at giving shares or selling shares because it gives people a bit of control over the business, and they're very reluctant to do that. So shares are not for everyone. On average, about 4% of businesses will think about issuing shares. And that takes me neatly on to the next sort of basic thing. Have to understand the difference between debt and equity. Debt is where things like a mortgage, hire purchase, leasing, invoice factoring and discounting, where you're borrowing some money which you expect to repay. And the person lending it expects some interest on their loan, but also they expect repayment. With equity, what you're doing is selling a share of the business. The person doesn't expect repayment, but what they do expect is when you make profits to receive a dividend, over time the value of their shares in the business to increase, so that if they have to sell the shares, they can make a profit on the sale of the shares. So I understand that basic difference between debt and equity. Okay, next thing, I've listed some startup and early stage finance items on the next slide. I'm going to pick on 4 as there are 11 listed there, and some of the others will touch in greater detail later on. I'm going to start with credit cards. If you're a small business working from home, a credit card may be all you need, because you're based at home and you're buying things like stationery or small items of office equipment. You want to use your car, so you think about buying petrol. So a credit card might be all you need if you're a small startup business. The only thing with a credit card is make sure you keep an eye on how the limit is going and you manage that limit so you don't go over it. Next thing is credit unions, Association of British Credit Unions. Now credit unions, there are lots of them around the country, and what they basically do is expect people to save with them, and you set up a regular monthly savings, say £100 you save with them, and after a period, which is usually about 3 or 6 months, if you've been investing £100 a month, they would allow you to borrow up to 18 months, the sum up equivalent to 18 months of what you've repaid. Because you're showing, if you save regularly, you're showing that you can capable of repaying it. So that's a credit union. And there are lots of them around the country, and I've listed the website there. Startup loans is another. It's a government innovation. It's a personal loan to people who've started in business, and they usually allow up to a year after you started trading. You can borrow up to 25,000, although the typical loan is 5,000 or 6,000. And again, it's a personal loan, repayable over 5 years, and they will give an interest holiday for the first year. But it's very popular. I think they've lent well over £100 million on that scheme. And the beauty of startup loans is it comes with some mentoring, so that they mentor you when you apply for the loan, and when you've got the loan, you get a mentor for about a year afterwards. So it comes with some benefits. And then the last one I want to highlight at this stage are the Community Development Finance Association, or it's now called Responsible Finance. Now, people with a bad credit history often go to the CDFA, because they will help people understand why they've got a bad credit history, and also what they can do about improving it. And it's amazing how a few steps taken over a period of time will improve your credit history, and that'll improve your chances of raising finance. They do lend money to businesses. It's a relatively small amount, but they do help people understand their problems with their credit history. So those are the 4 startup finance schemes. Some of them are not very well known, so I thought I'd highlight those. On the next slide, we talk a bit about the business's risk profile. I mentioned the people's adverse credit rating. Well, it is unfortunately the way that lots of finance providers use to judge whether people are suitable to have a loan. And they've got a variety of information. If you go to a bank will look at how you conduct your bank account. Have you ever gone overdrawn? Do you quickly restore the situation? How do you conduct your account? Do you always keep money in it? So a bank always have got your history to help them decide whether to lend you money. They also look at things like county court judgments and things like that. If it's a startup company, they will look at behind the startup company at the directors to see if the directors are creditworthy. And the last thing is one of the innovations I alluded to at the beginning. There was an act passed last year called the Small Business Enterprise and Employment Act, and that, if we turn over to the next slide, has given a lot more, is going to give credit reference agencies a lot more information, because banks will be required to share data with the credit reference agencies, And HM Revenue and Customs are going to share VAT registration details with the CRAs. And this last one about banks being forced to pass businesses refused credit to alternative finance platforms, I'm going to cover in a lot more detail later on, because this is quite revolutionary. So I will cover that in a lot more detail a bit later on. So, thinking again about banks, some of the new entrants into the market are banks. And I've listed a few there. They all tend to specialise in something. Handelsbanken is good at personal banking. It's the good old-fashioned type of banking. Their local managers have decision to have authority to decide up to £500,000 of loans or overdraft. So they're more traditional. Metrobank is new, open long hours, and the others have specialist lending capabilities. So bits, they are specialised, but they're well worth thinking about. The other thing I want to say about banking, and this is not very well known, a few years ago the banks were compelled by the government to give people who were refused finance a second chance. And what this entails is you don't have to reapply. All you do is when you are told, I'm sorry, we're not going to give you finance, the bank puts it in writing, you can then apply to the bank for a second chance or an appeal. And what happens there is a totally different team of people look at your application from the start. And they have got 30 days to give you a second decision. And interestingly, in the first 2 years of this system, 40% of appeals worked. The people ended up getting money. It's dropped a bit since, but it's well worth trying. You lose nothing by this appeal process. As I say, it's a second pair of eyes, totally fresh, totally independent. So you're starting from new. Right, we're going to touch on now on the newer online sources of finance, because as I said at the beginning, there are now over 100 of them, and they break down into 4 different categories. Donation crowdfunding is simply a charitable donation. Reward crowdfunding is quite popular with businesses that are developing products, and businesses can use it to sell products that are not generally available, but people want to buy them, and they'll pay a premium because they are rare. And product development is quite a common reason why people go into reward crowdfunding. And what that does is give the company, the business, money to then develop the products further and work on their marketing. Equity crowdfunding is selling shares through the internet. Lots of rules and regulations with that. As you will know, lots of rules and regulations. You need to do due diligence. Lots of rules and regulations. The one I'm going to focus most on is peer-to-peer lending or online debt funding. That is the most common method at the moment of raising finance online. So I'll take you through the process in a minute. And basically what this is businesses are trying to match, the platforms are trying to match businesses which are looking for money with people who've got money to lend, looking for a rate of interest. So how does it work? Well, first of all, you have to fill in an online application form. And you apply to the platform, fill in the online application form. In my notes, I've listed some of the things that Funding Circle, which is probably the most well-known peer-to-peer lender, asks for. They want 2 years accounts, they want management accounts if you're well into the year, and they probably want a bit of, make sure you're making a profit, and a reasonable credit history. Assuming you've got all that, you go on to the application process, and the Funding Circle say they will give a response within 2 days whether you get a listing. So within 2 days, which is very fast, they will be saying, I'm sorry you've been unsuccessful, or right, we're going to list you for finance. Once they're accepted, they go on to an auction. And what the auction does is You say, I want £50,000 and I will repay it over 5 years. And then you get the crowd coming in and saying, right, I'm prepared to lend you £5,000 at 15% interest. And people bid to lend amounts at varying rates of interest to the business. And what tends to happen over time, it's the opposite of an auction. The interest rate tends to come down rather than going up. The firm, very often then the business will get their £50,000 and what they will get it, they'll get it at various rates of interest. So the business can then say, right, I've got my money, I'm satisfied, or they can leave the auction open for another 14 days and hope to get that interest rate lower again. After that, the bids are accepted, and then this is where the platform comes in. It's crucial in what happens next. They take the money from the bidders, pass it to the business, they charge an arrangement fee, which is often a percentage, but sometimes it's a fixed fee, and then the business gets its money, and then they go on to their business. Every month they make their repayments of interest and debt. That goes to the platform, and the platform then distributes it to the various lenders. The role of the platform is crucial, and when peer-to-peer lending first started, there was lots of worries. Well, what happens if the platform goes bust? Well, they all have to have a form of living will now, so that if they go bust, there's somebody standing behind them who will take over the responsibilities that they had. So it's a lot more assured now in that sense. I've listed in my notes there a couple of trade organisations, one for debt funding, one for equity funding, crowdfunding. How does peer-to-peer lending compare with bank finance? Well, I think some of the advantages are quite obvious. With peer-to-peer lending, you tend to get your answers fairly quickly, probably much quicker than a bank will do. And the process is generally much quicker, except where security is involved. Where security is involved, I think the banks probably are not take that much longer than peer-to-peer lending does. The interest rates with peer-to-peer lenders tend to be higher because of this bidding process, but not always, but they tend to be higher. What's in it for lenders? Well, they get quick decision, and peer-to-peer lending is at the early stages, so there haven't been many bad debts. What happens when we get a bit of a downturn and more businesses go under, we'll have to wait and see. Some of the peer-to-peer lenders are building up a store of provision against bad debt, so if a debtor defaults, they will have some money to contribute towards the lenders who've lost money. And that's the other thing. When they started, the loans were not offsettable against tax. And there's certainly, unlike lending to a bank, there's certainly no recovery from the Financial Services Compensation Scheme. So that's something lenders have to be aware of. If you lend money to a bank, your money up to 75,000 is guaranteed back by the government. With peer-to-peer lending, it isn't guaranteed. So you are taking a risk. On the other hand, they've relented a bit so that the interest that you pay, that you would normally pay tax on if you're a lender, you now get tax relief if you lose money by a company going bankrupt. So there is some bit more equality in the system at the moment. Right, I'm now on to the section about the changes that are taking place. In the Small Business Act, there is passed this requirement that banks must refer businesses refuse credit to alternative finance platforms. Now this is very novel, it hasn't happened yet, it's going to start probably in the third quarter of this year. I'm sure there'll be lots in the media about it, so let me just take you through the process. What will happen is you apply to the bank as normal, the bank says, I'm sorry, we're turning you down. What they will then say is you can appeal, don't forget you can appeal, and you may choose to do that. Alternatively, we can refer you to an alternative finance platform. And some banks have been making arrangements with peer-to-peer lenders, so they offer their own version of this. RBS NatWest have got an arrangement with Funding Circle. If you don't accept that one, the British Business Bank, which is a government body, is currently evaluating 21 alternative finance platforms. They're going to recommend to the Treasury 4 or 5, and these 4 or 5 will be the ones that the bank will refer the applicant to. And then there are 2 models of this. Either the applicant will simply take the details of the lender, the potential lender, and send them out to all the various finance providers, or they will get from the finance providers the details of what they're looking for. They will then vet any details they get of potential lenders and only refer them to the one that's most likely to lend them money. So it's a completely new system. It's a bit of a shot in the dark. Happens later this year. I think it's going to revolutionise lending. As I say, at the moment about 80% of lending is done by the big banks. I think they are a bit concerned about this, because I can see the alternative finance platforms being a major force over time. So that's a major new development. The British Business Bank, I mentioned the British Business Bank, it's a government body which is there helping businesses to borrow money. They haven't got branches in the high street. They lend to banks who lend to people they wouldn't normally lend to, by offering guarantees and the like. They've got 80 partners, so they are a force for good in small business lending. Right. One of the things that does puzzle me a bit is when there's a survey called the SME Finance Monitor, and it publishes statistics quarterly on small business finance. One of its findings is fairly constant. There's very few people go and get external advice before applying for a loan. It's about 8 to 10% for an overdraft, and it's about 20 to 25% for a loan. Now, it seems to me that if you could enhance your chances of getting finance by taking external advice, it's well worth doing. I know the cost potentially puts people off, but I think it's worth doing to increase your chances. And this is where our members come in. Many chartered accountants will give advice on raising finance. So they can take you through the question that I asked about at the beginning. Do you need finance, or do you just need better financial management? They can take you through that. If they agree with you that you need finance, they can say, right, what type of finance do you want, or what type of finance do you think you need? They can help you prepare business plans and financial forecasts, which would be essential if you are going to get finance. And then they can help with actually applying for the finance, having discussions with finance providers. So I think that's a role that accountants are well suited to. I have then finally to tell you one thing about the ICAEW Business Advice Service. And you'll see our logo there, that's the Business Advice Service logo. And what this is, we've got 16,000 firms. 4,000 of these firms have agreed to offer free business advice to any startup or early stage business. And how it works is you go on the Business Advice Service website, and the website is listed there and in the Startup Finance document, it's on the back. You go onto the website, look for the Find a Chartered Accountant section. Once you're on that, you put in your postcode. Up will come a list of firms. Look for the ones with the BAS logo. There's a facility on there to email the firm and just simply ask you say a bit about yourself, a bit about your business, and what it is you want to talk to them about. And that's simply to make sure they get the right person in front of you. At the meeting, arrange a meeting. At the meeting, you talk about whatever the issue is, and have a good discussion. There's no commitment. You can walk away. In fact, you can go back and do the same thing again with another firm if you want to. So it's a way of accessing advice. We hope that you'll be so impressed by the people in front of you, you will employ them, but that's your choice, and you don't have to choose them. And it's a good way of, it's a very personal thing, being an accountant to a business, and it's good for you to get the chance to meet people, meet accountants, and decide whether you get on with the person or don't. Are they interested in your business? Can they help you? Lots of things you can ask yourself and get answers to at a BAS meeting. Okay, that's it.
Great.
Any questions?
Clive, I think we'll say thank you from the digital audience and sign off. So take it away. Thank you so much. And please, if you're watching online, you can tweet in any questions that you have and Clive will answer them. Thanks.